Why 2025 is the perfect year to start investing. 2025 is shaping up to be a transformative year for the financial world. With new opportunities emerging in technology, renewable energy, and global markets, the investment landscape has never been more exciting. If you've been waiting for the right time to start investing, that time is now. But where do you begin? Starting your investment journey can feel intimidating, especially with so much information and misinformation out there. That's why we're here to guide you with 5 essential tips to start investing in 2025. These tips will help you build a strong foundation, avoid common pitfalls, and take confident steps toward growing your wealth. Before we get started, don't forget to subscribe to our channel for more financial advice, like this video, and leave a comment sharing your investment goals for 2025. Let's build your financial future together. 1. Define your goals. Short, medium, and long-term. Investing without clear goals is like sailing without a map. To create a strategy that works, you need to define what you're aiming for and when you want to achieve it. How to set your goals. Short-term goals, 1 to 3 years. Examples include saving for a vacation, buying a new laptop, or building an emergency fund. Medium-term goals, 3 to 5 years. Goals like purchasing a car, paying off student loans, or starting a business fit here. Long-term goals, 10 plus years. Think about retirement, buying a house, or building a legacy for your family. Why this matters. Knowing your timeline and financial needs will help you choose the right investment vehicles. For instance, short-term goals may require safer options like high-yield savings accounts or short-term bonds. Long-term goals can involve higher-risk assets like stocks or real estate for greater growth potential. Practical steps to take. Write down your goals and assign a specific dollar amount to each. Use financial planning apps like Mint or Personal Capital to track your progress. Break larger goals into smaller milestones for better manageability. Extra tip. Review your goals annually to adjust for changes in your financial situation or priorities. 2. Build an emergency fund before investing. Investing is a powerful way to grow your wealth, but it comes with risks. Having an emergency fund ensures you're financially prepared for unexpected events without having to sell your investments prematurely. What is an emergency fund? An emergency fund is a financial safety net designed to cover essential expenses for 3 to 6 months. This might include rent or mortgage payments, utility bills, groceries, medical expenses. How to build it? Start small by setting aside 10% of your monthly income. Open a high-yield savings account to store your fund and earn interest. Cut unnecessary expenses like subscriptions or dining out to accelerate your savings. Why it's important. Without an emergency fund, a sudden expense like a car repair or medical bill could force you to liquidate your investments, potentially at a loss. Extra tip. Use automation to make saving effortless. Schedule automatic transfers into your emergency fund each payday. 3. Start small and diversify your portfolio. One of the biggest myths about investing is that you need a lot of money to start. In reality, starting small is not only possible but also a smart way to learn and minimize risk. How to start small. Micro-investing apps. Use platforms like Acorns or Stash to invest as little as $5. Fractional shares. Invest in big-name companies like Apple or Amazon without needing thousands of dollars. What is diversification? Diversification means spreading your investments across various assets to reduce risk. A well-diversified portfolio might include stocks, high growth potential but higher risk; bonds, lower risk with steady returns; index funds/ETFs, affordable and diversified exposure to markets; real estate crowdfunding, invest in properties without owning them outright; cryptocurrency, a high-risk, high-reward option for those comfortable with volatility. Benefits of diversification. Protects your portfolio from significant losses if one asset underperforms. Increases the likelihood of stable returns over time. Extra tip. Rebalance your portfolio every 6 to 12 months to maintain your desired allocation and risk level. 4. Educate yourself and develop a strategy. The key to successful investing lies in knowledge. Understanding the basics of how markets work, different types of investments, and your own risk tolerance is crucial before putting your money on the line. Ways to educate yourself. Read books. Start with classics like The Intelligent Investor by Benjamin Graham or Common Sense on Mutual Funds by John Bogle. Follow reputable resources. Websites like Investopedia and Morningstar offer beginner-friendly guides. Take online courses. Platforms like Udemy, Coursera, or Khan Academy have excellent courses on investing. Create a plan. Assess how much money you can allocate for investments after covering your expenses and building your emergency fund. Decide between active and passive investing strategies. Set a timeline for reviewing and adjusting your portfolio. Why strategy matters. Investing without a plan often leads to impulsive decisions based on market trends, which can hurt your long-term gains. Extra tip. Start by practicing with virtual trading platforms to gain confidence without risking real money. 5. Think long-term and stay consistent. The most successful investors understand that wealth building takes time. By adopting a long-term mindset and sticking to your plan, you can ride out market fluctuations and see significant growth over the years. The power of compounding. Compounding occurs when your investment returns generate additional returns. For example, if you invest $1,000 at a 7% annual return, it will grow to $1,967 in 10 years. Over 20 years, it becomes $3,869, and in 30 years, $7,612, without adding extra money. How to stay consistent. Automate your investments to ensure you contribute regularly. Avoid checking your portfolio too frequently to prevent emotional reactions to market dips. Focus on your long-term goals rather than short-term volatility. Why patience pays off. History shows that markets tend to recover from downturns and grow over time. By staying invested, you give your money the best chance to multiply. Extra tip. Use visualization tools to see how your investments will grow over time. This can help reinforce your commitment to long-term investing. Conclusion. Your investment journey starts now. 2025 is your year to take control of your financial future. By defining your goals, building a safety net, starting small, educating yourself, and staying committed to the long term, you'll set yourself up for success. Remember, investing is not just about growing your money, it's about building a life of freedom and opportunities. Subscribe to our channel for more financial tips, like this video, and let us know in the comments which tip you'll start implementing first. Together, let's make 2025 the year you transform your financial future.